Term versus whole life insurance. It's one of the biggest argued about topics in insurance, and most people arguing about it actually have a commission incentive to push you one way or another. I'm going to break it down for you honestly so you can make the decision for yourself. Someone's probably already told you that the whole life insurance is the smarter investment. It builds cash value, covers you forever, which sounds amazing, right? But here's what they didn't talk about. They didn't mention that it costs 5 to 10 times more than term. Most Canadian families with a mortgage and kids can't actually afford enough coverage when they go that route. Today, I'm going to give you the honest answer that nobody in the industry wants to talk about or say out loud. So what are they? What is the difference between term and whole life or a permanent insurance type of plan? Here's the basics. For term insurance, it covers you for a specific period of time, 10, 20, 30 years. It pays out a lump sum if you die within that time period. It's pure protection, no cash value, no investment components. The premiums are fixed and affordable. I think of it kind of like renting insurance. It's straightforward, affordable, does the job. What's whole life then? It covers you for your entire life, guaranteed, no matter what. It includes cash value on the inside that grows over time. But here's the catch. The premiums are significantly higher, about 5 to 10 times more than term insurance. Although they're higher, you can borrow against your policy or surrender it for cash. I like to think of it more like buying. It's more complex, a little bit more expensive. There's more moving parts. Here's the key question. It's not which one is better, but it's which one is right for where you are right now. Here's the honest pros and cons between the two. This is why I believe that term insurance makes most sense for young families. When you're young and you have a young family, you need higher coverage right now. You have things like a mortgage, kids, you need to replace that income. Your budget is tight. Every single dollar counts. Your biggest financial risks are time limited. Things like your mortgage, it's going to be paid off in 25 years. Your kids are going to be grown up in 20. You can invest the premium difference separately, and you often come out ahead. So why does whole life get oversold? Because there's a higher commission for advisors. The cash value growth, even though it's there, it's very slow and often underwhelming. Most families buy too little coverage because the premiums are too high. Think about it. $300 a month for $200,000 in coverage versus $50 a month for $750,000 in coverage. Which one sounds like it protects your family better? When does whole life actually make sense? Because it does make sense for some people. When you're estate planning and you want to leave a guaranteed legacy. You're a business owner with specific tax strategies. You're a high income earner who've already maxed out your RSPs and TFSAs. Or you have permanent dependents who will always need financial support. According to the Canadian Life and Health Insurance Association, in 2023, 74% of Canadians have some form of life insurance. But the average coverage amount is significantly below what financial experts recommend. Most families need between 10 and 12 times their annual income in coverage. Yet the average Canadian is covered for far less. And that's often because they chose a more expensive policy and couldn't afford the adequate coverage amounts. I worked with a couple one time. We're going to call them Marcus and Diane, 34 and 32 years old. They had a mortgage of $480,000, 2 kids under the age of 6. Marcus was earning $88,000 a year. An advisor had recommended a whole life policy for Marcus for $280 a month that provided $250,000 in coverage. Sounds all right until we actually break it down. $250,000, it barely covers half their mortgage, let alone next 18 years of income replacement for the 2 kids. We switched them to a 25-year policy, $900,000 in coverage at $62 a month. Same budget, nearly 4 times the coverage. We got Diane a $600,000 policy for $38 a month. Their family is now properly protected for $100 a month in total instead of $280 a month for inadequate coverage. Let's say you need $750,000 in coverage. A 20-year term policy for a healthy 35-year-old, it's about $45 to $55 a month. But a whole life policy for the same amount of coverage, it would be like $400 to $500 a month. That's a $450 difference every single month. If we invested that same $450 in a modest 6% return over the next 20 years, you'd accumulate roughly $208,000 in additional wealth, on top of having the same coverage. The math rarely favors whole life for families in the wealth building phase of life. So how do we decide what's right for you? I would choose term if you have a mortgage and dependents. You're in your 20s, 30s, or early 40s. You need maximum amount of coverage on a real world budget. You plan to invest separately through RSPs or TFSAs. When do we consider whole life? When you've maxed out all the other investments. You have estate planning and legacy goals. You own a business with specific insurance needs. A qualified advisor has shown you the numbers and they actually make sense for you. So here's the bottom line. Get the right amount of coverage first. Always. The type, it matters far less than making sure your family is actually protected. A $1 million term policy, in my opinion, sure beats a $200,000 whole life policy every single time for a family with a mortgage and kids. Here's what this really comes down to for you. If you've got a mortgage, kids at home, and you're still building your financial life, term insurance almost always gives you and your family the better protection per dollar. That doesn't mean that whole life is bad. It just means the timing isn't quite right. Right now, your job is to make sure that your family doesn't lose everything if something was to happen to you. We want to get that foundation solid first. Then we build it up from there. If you're sitting there trying to figure out which one actually makes sense for your specific situation, for your mortgage, your income, your kids, for your family, that's exactly what my free clarity call is for. It's 20 minutes. No pressure, no sales pitch. We'll just take a look at what you have and what you actually need. I'll give you a straightforward answer that you can act on. You do not need to figure this out alone. You don't need to walk away confused ever again. The link to book is in the description below. 20 minutes now could mean that your family is properly protected for the next 25 years. I really want to make sure you get this right.